All right, hey everyone. Sorry about that. A little late dialing in there. Okay. Well, good morning and welcome. Thank you for taking the time to join live. I know it's a kind of a slow week for most of us as we get ready for the holidays. But let's talk a little bit about what is transpiring here in the world. Overnight, so we've got several things going on. Overnight, the big news, if you look at oil, it's down 250 a barrel right now. Um, the big news is unrest in China. We've got uh, uh, riots breaking out. Overnight, there was a riot that broke out in an iPhone factory over there, and apparently those people had been locked up for over 2 weeks dealing with COVID lockdowns. And that's a specific example of a much broader issue. Apparently, approximately 20% of the Chinese population are currently experiencing a lockdown issue or some sort of a COVID restriction, and and that's going to continue to drive more and more civil unrest. So the oil market doesn't like that at all, obviously, because if the Chinese can't go anywhere, then that's bad for demand. We also have the oil market jittery because of the he said she said information coming out of OPEC. The Wall Street Journal published an article day before yesterday saying that OPEC had agreed to production increases, which sent the price of oil plummeting. And then Saudi Arabia came out and said, no, 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 that's not true. We don't know who said that, and that sent oil back up yesterday, and actually caused a massive reversal on today's Wednesday. That would have been Monday. So you have lots of two-sided, lots of swings and volatility in the oil market, and that is and should spill over into our grains just a little bit, right? Because both soybeans and corn have a huge energy component. So if you look at the volatility we've had in corn, you got to say it's been an absolute rock star compared to oil. It just has not broken, and it seems to be holding in there. The other news that is significant, and it's twofold. One, we have the threat of railroad strike coming up in December 5th, I believe, is the date for lockdown, or the date for the deadline for the negotiations. You know how those are, right? They can be extended, moved, whatever. It's a deadline set by humans, so anything can happen there. And I don't think anybody knows what's going to happen. And I read both ways. Okay, so Jeff just sent me a text saying that his is not working. I think everyone can hear me. Mitchell, can you hear me okay?
Yeah.
Okay, Mitchell can hear me fine. Okay, so sorry, Jeff. It must be on your side maybe. Okay, so as far as what was I talking about? I was on railroad strikes. So as far as whether a railroad strike, if it were to materialize, is bullish or bearish, I really don't know what it's going to do to futures prices. I don't know how that's going to be impacted. I would think that would be supportive to local basis levels if the railroads go on strike because of the deficits that we're in. That would be logical. That would make sense to me if that were to materialize. But I don't know for sure how the market would react, because I'm sure buyers have been trying to prepare for that if in case that eventuality happens. So sometimes you could end up with a buy the rumor, sell the fact kind of a situation there as well. We have heard rumors that basis levels in some parts of western Kansas and southwest Nebraska have broken as much as 30 to 40 cents over the last few days. I don't have any confirmation of that. Those are just rumors. What we are seeing on our own bids is really the opposite. We've seen strength and we've seen support. So I don't know if those rumors are accurate or not. Sometimes it takes some time for those basis levels to move. from a pure fundamental standpoint, we haven't generated any new bushels. We haven't harvested anything new. The market's not being overwhelmed with new supply, and if anything, the supply situation is getting tighter because of dryness in South America, specifically Argentina. We have quality issues in Australia relating to their wheat crop, and we have the Ukraine harvest nearing about 50% complete, and some people think it may stay in the field a long time just because of diesel fuel shortages, right? So supply is not getting any bigger than what we've previously known, and demand is at best suspect because of the oil volatility. I think that's the best way to think about it. So the question is will this market will this market break because of demand uncertainty, or will it wait for confirmation of it? And if it's going to wait for confirmation of it, then you would have to assume that if it doesn't happen, then we're going to put premium back in because demand is going to be stronger than what we might have thought. And supporting that logic is the fact that is the rumors and the information coming out of Florida that we may have imported a wheat miller has imported boats from Europe into Florida, and that is super counterintuitive to think that might actually be supportive to our markets. But what it would imply is tight supply in this area, meaning that they can't get the bushels to flow that direction because it's so supported in the central part of the states. So as new as the marketing year is, and as tight of a balance sheet as we have, if we're already having to resort to imports for basic milling needs, then that could be truly significant and supportive to the wheat market as well. So now technically, I'm going to show you wheat doesn't look very good, and all these markets are kind of pressing on the downside and the downward comfort levels for what we want to deal with. So now let's take a look at all our technicals, and so that we can kind of put on perspective. Because remember, all that stuff, everything in China, everything in Europe, everything in weather, everything about the railroad strike, everything that anybody might know, 95+% of that information and knowledge is printed right here on the most recent price of corn. As technicians, we have to believe that to our absolute core in order to understand. We're not trying to outguess what the railroad strike is going to do here, and we're certainly not going to risk your farm on that. What we're going to do is we're going to say, hey, let's look at where we are objectively. Let's accept the fact that the traders have already digested that information and put us right to this spot, and that this is reflective of everything, and the market's waiting new information to push us one way or the other. And so this price action will be our guide, and it will tell us what we want to do. So where are we at? We had the big day last Tuesday, where we had a big the high low on Tuesday was a 24 cent range, and since that trade, we've been inside this bar ever since. So anytime that happens on a short-term basis, at a minimum, you have significant resistance at 677, and you have significant support at 653.5. Okay, so basic. We've traded inside this 1 day's range for many days. The high and low of that day means something to the market, right? Super simple. Now let's take this back just a little bit and look further back on the chart, and let's see if we can find any other logical points that would tie to a high or a low here. Well, the high is pretty easy. We've got all this stuff right in here, right? So if we break back above this, we're now trading back into the top of this range. You would imply that would be bullish if it went on up. Likewise, look back to this chart. Let's count them. Here's one significant low that ties directly to the low from last Tuesday. Here's one, and that's August 26th, low of 653.25. And this is a March corn that we're looking at, okay? So here's one. Here's another open that was right at the same exact level. Here's 2 spike lows that reversed, that we traded down through this level and reversed from, and now come back all the way back into March. Here's a significant spike low with a subsequent swing low right here. Here's a peak, and here is another spike high where the market traded to and reversed from. So that's 1, 2, 3, 4, 5, 6 significant points, 7 including last Tuesday, where the market traded 653 and either reversed either from the top side or the bottom side of that market. When we see a combination of 7 points within a trading year on the same chart, I think it's logical and safe to say that that's a really, really important level. So commit that number to your mind, 653 on March corn. That's the number that we are going to trade against. And we're gonna stick with that until the market kicks us out of that logic. I want to be long above this level. I want to be open cash. I'm happy maintaining ownership above it, and I'm not overly concerned about the downside below it. If we break it, and if we're lucky enough to break it and then get a throwback to it, we want to sell it. We want to be short below that sucker, and we don't want to overthink about it. We don't want to overthink things because it's significant enough that it should move the market one way or the other. All right, so that is corn. I can't make it any more simple than that. 653. That's our level. Now let's look at January soybeans. January soybeans trading mid-range of the cloud. We're trading the exact same level we traded in July. We are absolutely sideways in this market with no discernible trend. Obviously, the market is confused and waiting for some sort of direction. Lots of fundamentals can propel it either way, and a breakout is going to come. We have this nice wedge that's been formed from the summer highs. If I scrunch this up, so we draw from the summer high to the intermediate peak in September, held all this resistance. Clearly, this downtrend line is significant. We have this uptrend line from the July low that is held. It's significant. A breakout above or below, that's where we want to trade from. It's really not overly rocket science here. We're sold for old crop, so we're not worried about it. We're trading new crop. I don't want to get overly bearish until we see corn make a decision and until we see beans come out of this wedge. Once we come out of it, we'll become much more opinionated about where we want to go. But before that happens, you should expect more and more chop. If you had to, if you forced me to take a position, I would want to trade long above this low right here at 1406, and that's a round number at 14. So I would just say, hey, we want to be long above 14. This is our hedge line right here at 1417. So take it as a range, 1417 down to 1406. We want to maintain ownership or look for an upward breakout. But I would absolutely not take a new position in this thing until we take out these highs right here. We got to get above this line. We got to get some acceleration to the upside before we can challenge this 1512 level. So super neutral soybeans, and I don't expect much to happen there other than getting slammed around by crude oil. Okay, Kansas City wheat. I'm going to move this out to March. Okay, WEH23. All right, let's come out to March, Kansas City wheat, and look at what we're doing. Clearly, we've been down now 6 days in a row, and we keep trying to break lower. Now I'm going to put a few trend channels up here because I think these are significant. Okay, if I snap a point from this peak to this peak and go to the intermediate low in between them, you have a base channel developing to the downside down here. Okay, now if I go start from this one and come to this peak intermediate and and snap it to the intermediate low here, you have a secondary base channel. So we actually have 2 channels that wheat is trading, and then we have this sideways low, which is this spike low, this spike low. Yesterday we almost broke it definitively. This morning we are trading below it. but it's a tentative trade. It's very trepid. Why is that? Now let me move to just a flat trend line. What I want to do is show you from this point over here all the way. I'm going to take these two lows right here, and we're going to come all the way across and make this as straight line as I can make it. You'll see all the different points from which, just like corn, from which wheat has traded to and then reversed from and consolidated around. If you go all the way back to the March lows or to the March congestion area, you'll see spike lows right here at this level, and this is the level that we want to trade from in wheat. It's 894. It's this low right in here, and it's this range right in here that we want to trade from. So, and it correlates nicely to the 653 level that corn is at. Corn and beans or corn and wheat are cousins. They're related and they compete for feed needs. So if one gets out of whack with the other, then it changes feed rations. So at some point they are going to really trade together, and they're going to move in lockstep. So I think that this 653 level in corn is what the wheat market is going to key off of. The more time we spend towards the edge of that, wheat's going to flirt with the downside of these of these down channels and of this 893 level. The more time we spend above 653 on corn, the more likely wheat is to spike down, reverse from, and trade higher, because I don't think you're going to see wheat explode lower and corn explode higher. That doesn't make any sense given the setup that we have. Now, anything can happen. Markets can do whatever the hell they want, clearly, but I don't think that makes sense long term. So if we're managing risk, we're going to manage from that level right there, 893. I know it's not $9, but we need to give it a little bit of room both sides. And we're going to work on closes, not just absolute trade levels, because what all these commodities have done, and look at crude oil, look at bean oil, look at soybean meal, look at coffee, look at dollar, just look at cotton. All of them are tending to get to critical points and then spike up above or below and reverse from it. They're making it very, very difficult to establish a trend because we've been in these sideways ranges for a long time. So they're sucking algorithms in, engaging the sell side, and then buying it. And they do the same thing to the upside. They suck everybody in, and then they sell it, and it's like a baiting game or a game of whack-a-mole, where the algorithms just wait for the other ones to get sucked in, and then they engage and smoke them. So that's a signal to me to make it simple, pick a point and trade from it, and not argue with the market and not get wrapped up into the emotion behind what all it is doing. So for old crop, let's talk just marketing for a little bit. So for old crop, we like our price risk to be managed. We need to be aware and comfortable that we have downside risk, because yes, that low can go. If we've already sold, I'm comfortable with a nice risk reward here of 7 cents above 653 to re-own. If we're holding old crop, this is where we want to start dumping. For next year's crop, a move below 653 March is going to pique our interest and make us want to start selling and getting some hedges and protection in place for 23 as well. So I think it's a big number that we need to trade from. But for today, that's where we want to sit, and we don't want to overthink it. All right, remember, there is risk in trading futures and options, and you should only do so in light of your own financial condition. If you have questions, please call us. If you're uncomfortable with a position you have on, or something that you're concerned about, please call us. We will talk through it with you, and we are available for that at any time. I hope that's somewhat helpful. We will talk to you next week. Have a happy Thanksgiving.